Your bank is filing a federal report on you right now, and they are legally forbidden from telling you. Not because you did anything wrong, not because you're under investigation, simply because of how much money moved through your account. But here's the part nobody warned you about. The report itself won't ruin your life. What will ruin your life is the one instinctive thing most people do the moment they find out this rule exists. That single reaction, that gut-level attempt to protect yourself, is what transforms completely innocent, fully legal money into a federal criminal case. Last year, thousands of Americans had their savings seized. Money they worked decades to earn, gone. Not because they broke the law, because nobody told them where the real line was. I'm going to make sure you know exactly where that line is. Under the Bank Secrecy Act of 1970, every bank, credit union, and savings institution in the country is legally required to file what's called a currency transaction report, a CTR, anytime a customer completes a cash transaction exceeding $10,000. That report goes out on FinCEN Form 104, straight to the Financial Crimes Enforcement Network. That's FinCEN, a bureau inside the U.S. Treasury Department, not the IRS. The Treasury. Your bank files it, not you. You don't complete a form. You don't provide a signature. In most cases, you walk out not knowing anything happened at all. The bank has 15 days to submit it electronically, and they're required to retain that record for 5 years. This happens millions of times a year. And in the vast majority of cases, absolutely nothing follows. No phone calls, no frozen accounts, no federal agents at your door. A CTR is not an accusation. It is not a red flag. It is not the beginning of an audit. It is routine paperwork, automatic, unremarkable, and largely inconsequential. Remember that. Because the next part is where people destroy themselves. When most people hear about the $10,000 threshold for the first time, the reaction is almost universal. They think, well, if $10,000 triggers a report, I'll just deposit $9,500 instead. Or I'll split it across a few transactions. I'll keep it under the radar. That instinct has a legal name. It's called structuring. And under federal law, 31 U.S. Code 5324, structuring is a federal crime, not a fine, not a warning letter. A federal crime. It is illegal to deliberately break up cash transactions with a financial institution for the purpose of evading the reporting requirement. Here's what shocks most people when they hear this. It doesn't matter what the money is. You don't need to be laundering anything. You don't need to be committing fraud. You don't need to be involved in any crime whatsoever. If every dollar is completely clean, legally earned, legally inherited, legally gifted, and you intentionally break it into smaller amounts to stay below $10,000, you have committed a federal offense. The penalties are not small. For violations involving less than $100,000 over a 12-month period, up to 5 years in federal prison and fines up to $250,000. For violations over $100,000 or connected to any other illegal activity, up to 10 years in prison and fines up to $500,000. And in either case, the government can seize the money entirely through civil forfeiture. In 1994, the Supreme Court ruled in Ratzlaff v. United States that to convict someone of structuring, prosecutors must prove two things. First, that the person knew about the reporting requirement, and second, that they knew structuring itself was illegal. That's an important protection. But by watching this video, you now satisfy the first condition. If you walk out of here and break up a deposit, a federal prosecutor will argue you did it with full knowledge. Don't hand them that case. Here's the number that should stay with you. The IRS conducted a study finding that 91% of structuring forfeitures involved completely legal money. 9 out of 10 people who had funds seized were not criminals. They were ordinary people, people just like you, who thought they were being clever. They weren't. They were handing the government a case. Most people assume the CTR is the only report banks file. It isn't. There's a second one, called a Suspicious Activity Report, or SAR, and this one is significantly more dangerous because there is no minimum dollar amount. A bank can file a SAR on a $500 transaction. A $200 transaction, there is no floor. A SAR gets filed whenever bank compliance software detects behavior that suggests someone is attempting to evade detection. And that software is sophisticated. It doesn't see individual deposits. It sees patterns. $9,000 on a Monday, $8,500 on Wednesday, $19,200 the following week. The system doesn't register 3 unremarkable deposits. It sees a deliberate pattern and it flags it immediately. What makes SARS especially dangerous is this: you will never know one was filed. Federal law prohibits the bank from disclosing it. It is literally a crime for a bank employee to tell you a SAR exists. You could be flagged at this moment and have no way of knowing. CTRs are routine. SARs are targeted. And the difference between triggering one versus the other often comes down to a single bad decision about how you handle your own money. Let me walk you through the exact situations where retirees get this wrong. Scenario 1. Selling a car privately. You sell your vehicle for $14,000. The buyer pays cash. Completely normal transaction. You take the money to your bank. What people do wrong? They deposit $7,000, wait 3 days, deposit the rest. That is structuring. What to do instead? Deposit the full $14,000 in a single transaction. Bring a copy of your bill of sale. Buyer's name, your name, the date, the amount, both signatures. If the teller asks where the cash came from, say, "I sold my car." Hand over the document. A CTR gets filed. Nothing happens. You go home. Scenario 2. A cash gift from your children. Your kids give you $15,000 for a birthday, a medical bill, whatever reason. Doesn't matter. It's a gift. Someone told you to split it across 3 branches, or keep it under $10,000. Both of those people gave you advice that leads to a federal crime. Here's the actual law on gifts. In 2025, an individual can give up to $19,000 per recipient per year with 0 reporting requirements. Even above that amount, it's the giver who files a gift tax return, not you. Recipients of gifts owe no federal income tax on them, period. Deposit the full amount. Have your child write a short gift letter. Their name, your name, the amount, the date, and a sentence stating it's a gift with no expectation of repayment. File that letter somewhere you can find it. Done. Scenario 3. Moving your own savings. This one I see because the most unnecessary damage. You're consolidating accounts. Maybe after losing a spouse. Maybe you found a better interest rate. You decide to move $23,000, your own money, earned over decades, in several smaller transfers because dealing with a large transaction feels overwhelming during an already difficult time. I had a client, a retired school teacher, 69 years old, recently widowed. She was grieving. She moved her money slowly, a few thousand at a time over several weeks. She wasn't hiding anything. She was surviving. 6 weeks later, she received a letter. The bank's algorithm had flagged her pattern. It didn't know she'd just buried her husband. It didn't know she'd spent 35 years teaching children to read. It saw repeated deposits below $10,000 and filed a SAR. She was eventually cleared. But the legal fees, the months of anxiety, the stress layered on top of unbearable grief, none of it had to happen. If you're moving your own money, move it all at once. Keep statements from both accounts and a transfer confirmation. One transaction, clean record. No pattern to flag. Scenario 4. An inheritance. Your sibling passes and leaves you $40,000 from their estate. The executor sends a check, or in some cases, hands you cash from a safe. Either way, this is an inheritance. For the overwhelming majority of Americans, there is no federal inheritance tax on this money. The estate tax exemption currently exceeds $13 million. Unless your family member was extraordinarily wealthy, this money is yours, tax-free. But if you receive it as cash and deposit it in installments over several weeks, the bank doesn't see a grieving family member. It sees structuring. Deposit the full amount. Keep a copy of the will, the estate settlement letter, or the executor's documentation. That paperwork is your complete defense. Scenario 5. A Social Security lump sum. If you delayed filing for Social Security, you may receive a retroactive payment covering several months of back benefits. That amount can easily exceed $10,000, and when it hits your account, a CTR is automatically filed. Some retirees panic when they see an unexpectedly large government deposit and start shuffling money between accounts in smaller increments. That behavior, even with Social Security funds, can generate a SAR. Leave the money alone. The Social Security Administration has a record of every dollar sent. Your bank has a record of the deposit. The documentation exists automatically. You don't need to manage it. Don't manufacture a problem where none exists. Some of you have heard about a proposal to lower the reporting threshold to $600. That caused significant alarm a few years back, and confusion still lingers. In 2021, during debates over the Build Back Better Act, there was a proposal to lower the 1099-K reporting threshold for digital payment platforms, Venmo, PayPal, Cash App, Zelle, from $20,000 down to $600. This was specifically about payment processors, not cash deposits at banks. That bill never became law. The Build Back Better Act failed in the Senate in December 2021. The legislation that did pass, the Inflation Reduction Act of 2022, did not include those changes. The $10,000 CTR threshold on bank cash deposits has not moved since 1970. There is actually a current proposal called the Streamline Act, introduced in October 2025, that would raise the CTR threshold from $10,000 to $30,000 and index it to inflation every 5 years. That bill has not yet passed. But notice the direction of the conversation. It isn't toward lower thresholds, it's toward higher ones. For now, plan around $10,000. When you make a large deposit, a teller may ask where the money came from. This is normal. They're trained to ask. It's a compliance requirement. Answer briefly and honestly. I sold my car. It's a gift from my son. I'm consolidating 2 accounts. 1 sentence. Hand them any documentation you have. Stop there. Do not volunteer your financial history. Do not over-explain. And above all, do not say anything resembling, I want to avoid being reported, or will this trigger something? Those words can appear verbatim in a SAR narrative. If a teller suggests breaking the deposit into smaller amounts, the answer is no. Always no. If you ever receive a letter from FinCEN, the IRS, or the Department of Justice regarding your banking activity, stop. Do not answer questions. Do not sign documents. Do not try to explain yourself. Say 5 words. I'd like to speak with my attorney. That is your right. Exercise it before you say another word. The most important thing I can tell you today is this. The report is not the crime. The attempt to avoid the report is the crime. The $10,000 threshold isn't a trap set for retirees. It's a tool designed to detect money laundering and organized financial crime. But the software running those systems cannot distinguish between a cartel operation and a widowed schoolteacher who got bad advice from a well-meaning neighbor. The rule is simple. Deposit your money in full, in one transaction. Keep clean records. Never under any circumstance break up a deposit to stay below a threshold. Here's what you can do in 5 minutes today that protects you permanently. Create a folder, physical or digital. Label it Transaction Records. Every time you make a deposit over a few $1,000s, add 4 things. 1. A 1-sentence note on the source. Received $14,000 from sale of 2019 Honda Accord to John Smith, March 5, 2026. 2. Supporting documentation. Bill of sale, gift letter, estate paperwork, Social Security award letter, whatever applies. 3. Your bank statement showing the deposit. 4. Any transfer confirmation if money moved between accounts. You will almost certainly never need this folder, but if someone questions a transaction from 3 years ago, 5 minutes of organization will have saved you months of stress and thousands in legal fees. There is no age exemption, no retirement exemption, no I've been a good citizen all my life exemption. The law is uniform, but people with clean records sleep soundly. If you know someone who handles large amounts of cash, a parent, a sibling, a neighbor, send them this video. 20 minutes of information now could spare them years of consequences later. Drop a comment below. Have you ever deposited more than $10,000? Did the teller say anything? I read every single response, and the most common situations become future videos.